let's look at some specific ratios. ROA is return on assets. Return on assets is net income divided by total assets. ROE, return on equity, is net income divided by common shareholders' equity. Well, let's look at what happens when a company has more debt in the capital structure. If a company has more debt, they're going to have more interest expense. More interest expense means a lower net income. Well, if net income is lower and debts and assets stay the same, ROA is going to be lower. But let's look at ROE. If you have more debt, you're going to have more interest expense. It's going to lower net income. But if you have more debt, then you're going to need less in equity, and you'll have a higher ROE. Typically, lowering the equity trumps lowering net income. And typically, a firm that has more debt in the capital structure will have a higher ROE. Now, for firms that don't have any debt in the capital structure, ROA equals ROE. Otherwise, firms that use debt are going to have a higher ROE than their ROA. And again, for the most part, debt is a good thing. But let's look at some problems. ROE and shareholder wealth. Of course, they're correlated. Typically, if you have a higher ROE, that's good for shareholders. They're going to have a higher share price, and that makes the shareholders happy. But you cannot use ROE as the sole measure of performance. One of the themes of this class is risk and return, that you must be adequately rewarded for any risk that you're taking. ROE doesn't consider risk. It doesn't say, okay, we have a higher ROE because we're taking riskier projects. You need to be sure that you're making a sufficient amount of return to compensate for the extra risk that you're taking. ROE also doesn't look at how much it costs to earn that ROE. It doesn't look at invested capital. There are other measures which typically you talk about in accounting. One is called economic value added, that also looks at the capital invested. Managers might make decisions that benefit themselves if they, for example, get bonuses based on increasing ROE. So again, ROE is good, and typically you want a higher ROE, but it's not the final answer. We need to have a measure that looks at risk and return. That's a little bit more than we can do in this chapter, but it is something that we will see in later chapters. Now here are price-earnings multiples. And again, you can see bubble period, price-earnings multiples went through the roof, went down after the tech bubble burst, started to climb up again, went back down again because of the financial crisis. The P/E ratio really was thrust into prominence during the 1930s. There was an investor named Benjamin Graham, and I might add Warren Buffett, one of today's most successful investors, has modeled his investing after Benjamin Graham. And they looked at the amount of money investors were paying for a company's earnings, and that's the P/E multiple. Typically, companies that have strong earnings growth have higher stock prices and higher P/E ratios than those that don't. Now, the stock market's average price-earning ratio has been up, it has been down, depending on what's been happening in the overall economy. In the mid-2000s, 2008, continuing in 2009, and just now beginning to get better from 2008 onward, there was a pretty steady procession of bad news. European financial crisis, fears of deflation in the U.S. Many analysts said, hey, we think that firms aren't going to do so well in 2012. Market is worrying not just about a slowdown, but maybe even worse than a slowdown. You ask a dozen economists what the economy is going to be like, you're going to get a dozen different answers. So the P/E multiple still is important, but because of the way stocks are trading so incredibly quickly, very rapid-fire stock trading, the P/E ratio might be losing some of its relevance, not all. The emergence of exchange-traded funds, ETFs, in the past 10 years has allowed investors to make bets on the entire market basket of goods. So the PE multiple, still very important, still one of the key measures of a stock's value. But given the way PE multiples have been going up and down, sometimes it's harder to draw conclusions from just the PE multiple alone. There is a huge amount of disagreement about what PE multiples are going to be in the future as well. The DuPont system is a very nice series of ratios. The DuPont system breaks down ROE into its component parts. It says part of it is expense control. What's the profit margin? How are revenues relative to expenses? How is the company using its assets as measured by total asset turnover? And debt utilization. Does the company have a lot of debt, or does it have a relatively small amount of debt? Now, you can calculate ROE as net income divided by shareholders' equity. Calculating ROE using the DuPont equation is a lot longer and more complicated, but it sheds more insights on where ROE is coming from. Here's the full DuPont identity, that return on equity is equal to profit margin, net income divided by sales, times total asset turnover, sales divided by assets, times the equity multiplier, assets divided by equity. Now, the internal terms cross off and you end up with net income divided by shareholders' equity. But what's good about this ratio, it tells you what is contributing to profit margin. What is contributing? Is the total asset turnover contributing to ROE, or is it the equity multiplier that is giving a company a higher ROE?